What's good, everyone, and welcome back to the Financial Four channel. We are on our free money glitch series number 1, talking about company valuation part 2. We're about to look at a company's valuation metrics and how to learn the value of a share. This is the nitty gritty here. So grab your notebooks, buckle up, hands and feet inside the right at all times. Let's go glitch this money. So the first two tools we learned about provided basically no data regarding a company's financial health. So integrating crucial components like debt and asset values into the equation will give us a clear understanding, a clear picture of a company's financial health. Okay. So we first begin with the price to book ratio. So a price to book ratio, the PB ratio, is a common tool used to measure the value of a company's equity, aka the book value, relative to its market value, which is the share price times the shares outstanding. The book value is the value of the company if all the company's assets were sold and all the debt is settled. So we can kind of use three simple formulas to determine the PB ratio. So firstly, we need to work out the book value, which is the company's tangible assets minus the total company liabilities. This information you can find on the company balance sheet in the historical annual report section on the company's website. Okay. Then we divide the book value by the number of shares outstanding to get the book value per share. Finally, we divide the company's current share price by the book value per share to get the PB ratio. Okay. So as an example, let's say company ZYX has a $200 million market cap and a $300 million book value. And there's $400 million shares outstanding. And they are currently trading for 50 cents each. Okay. ZYX has a PB ratio below the number 1. So, and considering that its book value is higher than its market value, is probably overpriced. So because we can determine the value of a company if it were to go out of business using the PB ratio, a ratio below 1 indicates that a company is trading below the value of its assets, right? This indicates that the current share price is excessively inflated in relation to the company's assets, which can serve as a safety net for the share price, even though it doesn't guarantee that the company will increase in value to equal to its asset value, right? So investors are willing to pay a premium for a share of the company as long as the book value is high. Okay, you don't want a low book value, because negative market movements caused by like underperformance are exaggerated. Companies trading at a high BP ratio occasionally will be considered to be overvalued. All right. So PB ratios are reliable metrics that can be contrasted with a company's share price, and is also useful. It's a useful metric to use when comparing similar companies because it can occasionally reveal hidden value if a company is trading below 1, right? So when analyzing businesses with poor early year earnings, it's important to use the PB ratio. Okay, so without taking into account earnings, PB ratio can basically give us a deeper understanding of a company's true value, right? So because the PB can frequently be misleading, it should not be used alone. So in this calculation, only the business's tangible assets are taken into account. So when calculating the true value of a company, things like intellectual property and goodwill should also be taken into account as well. Okay. So then there's the price to sales ratio. So when comparing a company's stock price to its sales, we can use the PS ratio, right? Price to sales. It's basically a ratio that determines the price an investor is prepared to pay for a share, right? PS ratios are used to contrast businesses in the same industry that come from various sources of income, right? So to calculate the PS ratio, firstly, we just need to work out the sales per share, which is calculated by dividing the company's net sales for a 12-month period by the number of shares outstanding, right? We can then work out the PS ratio by dividing the company's share price by its sales per share, okay? So an example, net sales of a company are 200 million. There's 400 million in outstanding shares. You get the sales price per share as 0.5. Then you take the current share price divided by the sales per share, and you get the PS ratio of 5. So a high PS ratio indicates that a company is overvalued, right? So the best way to determine the average PS ratio, as with other ratios we discussed earlier, is to average out the PS ratio of other businesses in the same industry, or to compare it to the PS ratio of the sector index itself. So the use of projected sales information for the current year is known as a forward ratio. Okay, this can help our analysis because we can use projected targets to compare with historical data, which can highlight whether company sales are increasing, decreasing, or remaining stagnant. So if we compare companies in the same sector, a company with a better forward sales forecast will typically outperform its peers' stagnant sales, right? And, of course, we can find this on a company's balance sheet, which contains information on both actual and anticipated sales figures. With that being said, the use of a PS ratio should always be part of a comprehensive analysis strategy because, as we mentioned before, it does not take into account whether a company is profitable. So then we have the debt to equity ratio, which is basically used to assess a company's financial leverage, right? So you divide the total liabilities by the shareholder equity to get the D ratio. And you can also find the shareholder equity information on the balance sheet of the company's website. So as an example, say company CYX has 100 million total liabilities and a shareholder equity of 300 million. D ratio is 0.33. So investors will typically use the D ratio to assess a company's level of leverage, right? Which could cause them a significant risk during a market downturn. A high DE ratio suggests that a company or that a business may have been aggressive in financing their expansion, right? Now, even though the ratio is high, a business may still be a good investment because it may be using this debt to generate more income than it otherwise would, right? So for shareholders, it's advantageous if the additional revenue brought in by the high debt exceeds the interest payments on the debt. Okay, DE ratios can be tricky though. They can be tricky to compare to other businesses. So it's best to use this ratio in conjunction with other types of analysis. The use of a DE ratio to assess a company's level of debt should always be considered as part of any analysis process, right? Because it's important to keep in mind that high leverage will always increase risk, right? So how do we find the value of a share? Well, there's 5 steps, okay? So step number 1, an investor needs to understand the earnings potential of the company they're analyzing. So working out the earnings per share is the first most important part of the process. So the company's balance sheet contains information on a company's net profit needed to calculate the company's earnings per share. Then step 2, once the EPS is known, earnings per share, then you can work out the PE ratio by dividing the EPS into the current share price. Once the PE ratio is calculated, you can then compare this figure with other companies' PE ratios as well as the sector index PE ratio. Okay. Now we can make an assessment as to whether the company's placed where the company is placed against its peers and the sector in terms of growth and earnings potential. Okay. Then step 3, we also must be aware of how much equity a company has in relation to its market value. So once the PB ratio, price to book ratio, is known, we can make an assessment as to whether the company is in a strong financial position relative to its assets. Okay. If the company we're analyzing has assets that exceed the current market value, then the company could just be undervalued with a potential safety net to help protect it, right? So then step 4, the next step is to calculate the PS ratio to determine how the company stacks up against its peers and its sector in the terms of like sales revenue, right? We also need to carry out the forward ratio to understand what the forecast looks like compared to similar companies in the same industry as well, as this will help us identify growth opportunities. Okay. Then finally, step 5, we apply the DE ratio to gain an understanding of how much debt the company is using to fund its growth. If the debt level is high, we need to compare it to similar companies in the sector to identify if this is just a common thing in the industry, right? So as mentioned before, you cannot easily compare debt levels from company to company fairly, but you can gain an understanding of how the debt levels work for that sector, right? So as an example, if the company you're analyzing is the only company in the sector with high debt levels and the forward earnings forecasts are comparable to others, this means that the company is over leveraged and potentially at a higher risk than its peers. Okay, so please use these steps to give you a better idea of the company you're analyzing, because when combined, each of the ratios provide a powerful insight into a company's prospects and growth potential. Okay, this finishes off our third section in the Free Money Glitch fundamental analysis portion. Finally, we will learn about the last part of fundamental analysis: top down versus bottom up analysis. This is Bradley Barnett. I love y'all. From yours truly, Financial Freedom.